Welcome to Financials 101, a four-part video series designed to give you a foundational understanding of the three main financial reports every small business owner should understand and use, as well as a break-even calculation. This video covers the profit and loss statement, also known as the income statement. I'll explain how this report is structured, where the numbers come from, and most importantly, what to do if the numbers are moving in the wrong direction. Let's get started. I'll begin with this simple statement. Every financial activity of a business creates an asset or a liability. This statement is the basis of all three financial reports. In this video, we'll focus on the profit and loss statement. The profit and loss statement shows where the money went over a past period of time. Therefore, it uses real numbers that actually happened. It's a look backwards in time. It can cover a month, a quarter, or a year, but should be reviewed regularly. And it's useful to compare the current report to the same time last year so that you can identify trends. And if you notice the numbers are moving in the wrong direction, you can take corrective action. A profit and loss statement in its simplest form looks like this. It's designed to answer the question, how much profit did the business make, if any? Revenues are money that comes from selling the product or services. Now, if you have a loan coming into the business or you've collected sales tax on behalf of the state, that's not your money, so you're collecting it on behalf of Washington State. That's not included in this. Revenues are only the money that comes from you selling your products or services. Expenses are commonly called overhead, and it's the cost of operating your business to generate those revenues. If there's any money left over, that's your profit. Profit and loss statements have a particular structure to them. It begins with what's called the top line. That's gross sales or gross revenues. Remember, this does not include loans, any other money coming into your business. It does not include sales tax. It is only the money generated by the business, by you selling your product or services. The first thing we have to do is take out the cost to make those sales happen. That's called the cost of goods sold. It includes items that you would buy wholesale and then mark up and sell retail. The cost of goods sold would be the wholesale cost of that item. It includes the cost of raw materials that you then create a product from. So it's the cost of those raw materials for that particular product or that particular meal. But it also includes an item that stuff that you may use in your sales that you don't actually sell to the customer. So for example, let's say you're a house cleaner. The more houses you clean, the more cleaning products you have to buy. The cost of those cleaning products are part of the cost of goods sold. Even though you don't actually sell them to your customer, you do use them in servicing those customers. So that's part of cost of goods sold. These are called variable expenses because they vary with the amount of sales. If your sales go up, the number on this line goes up. If your sales go down, the number on this line goes down. That's a variable expense. Now, for those of you that have a pure service business where you're not creating a product, you're just selling your expertise or selling your time, then your cost of goods sold is zero, and therefore you can delete this from a profit and loss statement. You have no cost of goods sold for a pure service business. If we do the little bit of math there, what's left over is called gross profit, and it's from this money that we run your business. Coming out of that money next is called fixed expenses. These are expenses that don't vary with sales. You have to pay these expenses whether you sell anything or not. And it's typically called overhead. If we do that little math, take out the cost of operating your business, what's left over there is called earnings before interest and tax, often referred to as net profit. It's not truly the end profit. You see here that it's before interest and tax, hence giving you a clue about what's coming out next from this number. We take any interest that we received minus any interest that we paid. If that's a plus or minus number left over, we take that out of the earnings before interest and tax. That leaves us earnings before tax. Then we take out taxes paid to governments, like a B&O tax here in Washington State. And that leaves us with earnings after tax, or abbreviated EAT, because we can use that number to pay for things to eat. But in reality, that's not actually all your money. Remember, by design, a profit and loss statement only includes the money the business generated. So therefore, this earnings after tax does not include any loan payments you might have made. So in fact, this isn't really all your money, but it does show the profits generated by the business. Let's look a little bit deeper into the fixed expenses. I like to break up fixed expenses into three broad categories. General expenses, which cover rent, utilities, telephone, office supplies, kind of the basic operational side of your business there. It also covers marketing expenses, anything you do to promote your business, such as ads or promotions, trade shows you might attend, a booth at the farmer's market, anything you do to promote your business. And then finally, any payroll expenses. If you have a corporation or an LLC, this is where this part would kick in. So that's the structure of a profit and loss statement. Let's take a look at a sample one, a very simple example. Our friend Sarah opened a pie shop a few years ago, and she's agreed to share her profit and loss statements with us. Let's take a look at her current P&L from May of this year. Here we can see her gross sales, her cost of goods sold, and gross profit. And then from that gross profit, she takes out her operating expenses, which you see she's broken down into two general groups here, general expenses and marketing expenses. And you can see those listed there. When she takes her operating expenses out of gross profit, what's left is net profit, and you can see that's $1,443. Now, that's neither good, we don't know if that's good or bad or anything about it. And so what I'd like you to do is start thinking in percents. Now, what do I mean by that? Sarah takes each one of these line items and divides them by gross sales. When she does that, she gets a percent of sales for each one of those line items. Now, in thinking in percents, she might be able to see some trends here. Again, looking at just one data point, in this case May of this year, not very exciting. But let's say we condense this, just for simplicity, we condense this profit and loss statement into the basic categories here. And now she compares this with what she did in May of 2019 and May of 2018. For each of those months, she's done the same thing. She's taken each one of these line items of these categories and divided it by the gross sales from that particular month. This normalizes the numbers so that we can actually compare. So reading from right to left, from earlier to current, first thing we do is we look for trends. So Sarah sees numbers are moving. We ask, or she then asks, are they moving in the right direction? And if so, what's causing this? So let's take a closer look at this. We can see the cost of goods sold is moving from 67% down to 60%. Is that moving in the right direction? Yes, it is. What would be the cause of this? Well, perhaps Sarah is buying her raw ingredients more efficiently or more smartly. Perhaps she's buying bulk and therefore getting a volume discount. Or perhaps she's changed suppliers, found somebody that offers the same quality of ingredients but at a lower price. We look at gross profit, we can see that's actually increasing. No surprise, mathematically it would if she's decreasing her cost of goods sold. So gross profits are moving in the right direction. We now look at operating expenses and we can see those are decreasing. Are those moving in the right direction? Yes, they are. Sarah has gotten more efficient in some way. How did she do this? Maybe she's decreased, negotiated a better rent. Maybe she's found a cheaper insurance. She's done something to decrease her operating expenses and become more efficient in this. And because she's done all these things, you can see her net profit is moving up which is definitely in the right direction. That's what we're aiming for. She always asks every month, every quarter, every year, what can I do more of what works and less of what doesn't? But let's say the numbers are moving in the wrong direction. What can she do there? Well, let's take a look. Her goal here is to increase net profits. As you know, net profits is the result of gross profit minus operational expenses. So if we can increase gross profit and decrease operational expenses, then mathematically net profit has to increase. So let's take a look at each one of these, as Sarah does. Sarah, first, let's focus on that gross profit. Gross profit is the result of gross revenues minus the cost of goods sold. So to make gross profit get bigger, she can increase gross revenue and decrease COGS. So how might she do this? Let's take each step. She might be able to increase revenues by raising her prices, by increasing the perceived value. So maybe she can make special pies only available at certain times of the year that have a combination of flavors that no one else has. It doesn't cost any more to make those pies, but they have a higher perceived value, and therefore she can charge more for them. Maybe she can put some little special treat as a surprise in some of these pies. And because it's a kind of a surprise and delight, you don't know what you're getting, she might be able to charge a higher price for those, again, by increasing the perceived value. She might be able to increase revenues by finding more customers, reaching a different audience. Maybe she can target a particular demographic, if you will, maybe the wedding crowd, or more of a high-end party crowd, or maybe partnering with certain events, but somehow reaching an audience, a potential customer base that right now she's not reaching, or simply by widening her service area. So instead of just selling pies to her very small local community, maybe she could offer a delivery service. Hopefully that wouldn't cost more money, that would cater to the surrounding communities. She could also simply widen her selection of products. Again, not to increase the cost of goods sold, but trying to get just more revenue coming in by appealing to a broader audience with more flavors that she found through her customer research that people are looking for and would appreciate. For decreasing COGS, she might do several things there too. The important thing here is to decrease that number without decreasing quality. You don't want to reduce quality. People will pay less for a low quality product than a high quality product. So at the very least, Sarah wants to keep her quality the same, if not higher. She can decrease COGS, as I mentioned before, by buying in bulk for volume discounts, or by finding a different supplier that offers the same quality ingredients but for a lower price. She also might consider how she makes her pies. Is there a way to make that process more efficient, perhaps by automating in some way, or buying a piece of equipment that allows her to just make pies more efficiently? And perhaps the way that she's packaging could be done differently. Again, you don't want to decrease the perceived quality of the product, but maybe she can find a box that is cheaper than what she's using now. If she increases gross revenue and decreases COGS by any or all of these means here, mathematically, gross profit must increase. So that's moving in the right direction. Now, if she looks at operational expenses, here she has to look at each item line by line in order to figure out how can I do things better. So when she looks at general expenses, she can ask, how can I do this more efficiently? Can I, in fact, for instance, renegotiate a better rent? Can I find a cheaper cost of business insurance? Line by line, she asks, is there a way to do this more efficiently? Or do I need this at all? Moving down to the next general area of marketing, she could ask, what's my ROMS, my return on market spend? What's that? If you take the revenues, gross revenues for a particular month, and divide that by how much you spend in that particular month, you'll get a dollar figure. That dollar figure is the amount of sales you bring in for every dollar in marketing that you spend. Obviously, you want that number to go up. You want more sales to come in over time. thereby your marketing is getting more efficient. You do that by talking to the right audience. Get the right message at the right time. That requires market research. You want to use the phrase, using a phrase, speak into their listening. So maybe she can market to a particular kind of person that's looking for a particular kind of pie. And maybe there's a bridge club or some little niche that she finds no one else is really paying attention to that would love to have some of her pies. Again, market research is critical here. And then finally, she can look at her payroll expenses. Is there a way to reduce staff without increasing stress, perhaps by automating a process in some way? No one likes to fire employees. That's a terrible feeling to have to do that, and Sarah's no different than that. But fortunately, she did a break-even calculation and realized that she doesn't have to, but now if things are moving in the wrong direction, she may be forced to. Again, it's not a pleasant thing to do, but it's something that she has to look at. So that if she increases gross profit by doing any or all of those top actions that I've listed there, and decreases operational expenses in some way, then mathematically net profit must increase. She can then do more of what works and less of what doesn't. Focusing on that net profit is the key. And with that, I'll leave you with some words of wisdom from Jim Rohn, an influential entrepreneur and motivational speaker. This video was made possible by funding from the Pacific County Economic Development Council. My name is Jim Williams. I'm a trainer and business coach with Enterprise for Equity. Our mission is to help people with limited income start and grow their own successful businesses. For more information about our classes, please contact us.